Imagine you're buying this perfect, rock-solid house, right? But the contract literally forces you to also buy the burning building next door.
Oh, wow.
And you try to tell the real estate agent, like, hey, I just want the good house. And they just smile and say, sorry, package deal. Take it or leave it.
Right, which is just completely absurd in any normal market.
Exactly. And the real kicker here is that that burning building is about to be forced into your retirement account, whether you actually sign the contract or not.
It completely flips the whole idea of a safe investment on its head. I mean, you are basically being forced to absorb an incredible amount of risk just to get access to the one asset that, actually works.
And that scenario is exactly the reality we are unpacking today. Welcome to our deep dive into the impending June 12, 2026 SpaceX IPO, trading under the ticker SPCX.
Yeah, we are really looking at the largest public listing in financial history here.
We really are. So setting the stakes for you, the company is targeting a fixed price of $135 per share, aiming to raise up to $80 billion. And that implies a massive consolidated market cap of $1.75 to $2.0 trillion.
It's just a monumental event for global capital markets. I mean, if you look at the prospectus, the underwriters are aggressively marketing this as the ultimate can't-miss gateway to the commercialization of space and artificial intelligence.
But our mission today isn't to just read Wall Street's marketing brochure. We want to investigate the incredibly complex and, frankly, highly asymmetrical risk structure of this offering.
Right. We need to figure out if this is a genuine opportunity for you to get in on the future of space or if it's, well, essentially a retail rug pull.
Yeah, exactly like a setup designed to use public money as exit liquidity for the early venture backers. We've got a massive stack of sources today to help us figure this out. We're looking at S1 financial breakdowns, Morningstar intrinsic valuation reports, and even some pretty stark formal warnings from labor unions and consumer advocacy groups.
It's a lot of data to sift through.
It is. Okay, let's unpack this. Because to understand the risk, we have to look under the hood. What Wall Street is actually selling here isn't one cohesive space company at all.
Far from it. The principal structural challenge of this IPO is what analysts are calling the three businesses, one stock design.
Right.
Because as a retail investor, you are legally prevented from isolating your investment. You just cannot buy the profitable parts of SpaceX on their own. You're buying a consolidated entity that lumps together three vastly different divisions.
And they all have completely different margin structures and capital needs, right?
Exactly. Completely different risk profiles.
So let's play the skeptical analyst for a second and just break this down. First, we have the good part, the connectivity segment, which is Starlink.
Mm-hmm.
Looking at the numbers, this is the only division actually making a GAAP profit, meaning, by traditional accounting standards, they're genuinely in the black.
Yeah.
In 2025, they brought in $11.4 billion in revenue, which is like 61% of total sales, and they had a $4.4 billion operating profit.
Which sounds phenomenal.
It does.
Yeah.
I mean, subscribers jumped from 2.3 million to over 10 million by the first quarter of 2026. On paper, this looks like an absolute cash cow.
It does look like that. On the surface, it's a highly successful franchise, but you always have to look at the unit economics. The average revenue per user, or ARPU, is actually falling, and it's falling rapidly.
Oh, really?
Yeah, it dropped 33% from $99 a month to just $66 a month.
Wait, let me think about that. I guess to get from 2 million users to 10 million, you eventually exhaust all those wealthy early adopters. So they must be expanding pretty aggressively into lower income regions, right?
Exactly. Places like rural India, sub-Saharan Africa, Southeast Asia.
But they basically have to cut prices just to get anyone to sign up.
That is precisely what is happening. They are driving mass adoption, but it's at the expense of premium pricing. Now, pair that falling revenue per user with what the industry calls a really high capital replenishment cycle.
Okay, let's translate that for a second. Capital replenishment cycle essentially means these satellites aren't permanent fixtures in the sky.
Right, they aren't.
They degrade, they fall out of orbit, they basically burn up in the atmosphere. So you have to constantly shoot new hardware into space just to keep your current network running.
Yes. So think about it. Your monthly revenue per user is shrinking, but the multi-million-dollar cost of building and launching replacement satellites remains immense, and it's constant.
Wow. Which brings us to the second business in the bundle, the space segment, the rockets and the launches. They did $4.1 billion in revenue, but they posted a $657 million GAAP loss.
Yeah, a huge loss.
Even with 170 successful launches. And they're reusing booster rockets up to 34 times. If they're literally recycling spaceships, where is the leak in the bucket? How are they losing money?
The leak in the bucket is the Starship rocket. I mean, reusing the smaller boosters is incredibly efficient, but all of those operational profits from the routine launches, they are being completely consumed by a massive $3 billion annual research and development bill just for Starship.
So basically, the profitable launches are just subsidizing a massive science experiment.
A necessary one from their perspective. Starship is the critical foundation for literally everything else they want to do.
Right.
Without the heavy payload capacity of that massive rocket, they just cannot scale the Starlink network efficiently. And they certainly cannot launch their third business segment.
Ah, right. The third segment, the true money pit. The artificial intelligence segment, which includes XAI and X, they merged this into SpaceX in this non-arm's length deal back in February 2026.
Yes, they did.
This segment brought in $3.2 billion, but posted a staggering $6.4 billion operating loss. And the S1 filing cites $12.7 billion in capital expenditures just to build the Colossus data centers.
Well, the overarching vision, the grand pitch to Wall Street is to eventually deploy orbital AI computing clusters on the Starlink satellites.
Okay.
They want to literally move AI data processing into space.
It's just like buying that profitable coffee shop, but being forced by the contract to fund an experimental theater in this wildly expensive, cash-burning data center.
Yeah, that's exactly the structure.
If they're bleeding $6 billion in the AI division, Wall Street must be pricing this stock incredibly cautiously to account for that risk.
Right. See, that is where the reality of the market mechanics completely detaches from the fundamentals. The underwriters aren't pricing in caution at all. They bypassed the standard IPO book-building process entirely and just slapped a fixed price of $135 per share on the offering.
Let's put that $135 into context
Right.
because the numbers here are frankly wild. That is a 60.7% premium over the private tender offer from December 2025, which was just $84 a share.
Right.
In just 6 months, they magically added nearly $1 trillion in implied market cap. That gives the company an enterprise value to sales multiple of 93.6x.
Which is an unprecedented premium for a company operating at this massive scale.
Hold on, let's translate that multiple so we fully grasp how absurd it is. An enterprise value to sales multiple of 93.6 means that if you bought this company, you were paying over $93 for every single dollar of sales it makes.
Yeah, it's staggering.
For context, the rest of the technology sector trades at an average of about $3.50. You are paying a $90 premium for a dollar of revenue.
It requires a total suspension of historical financial gravity. To justify that $135 price, the lead underwriter, Goldman Sachs, built a financial model projecting consolidated revenues will hit $474 billion by 2030.
Wow.
But to get there, Goldman assumes the AI segment's revenues will magically scale by 100 times. They project it will climb from $3 billion today to $322 billion, basically capturing a massive chunk of a speculative $27.5 trillion global AI market.
But wait, standalone XAI has faced severe internal upheaval. The sources note that all 10 of its original co-founders left within 2 years.
Exactly.
And that Colossus data center in Memphis.
Right.
It is heavily dependent on a lease to a direct competitor, Anthropic. The internal foundations seem incredibly shaky. How do independent analysts look at Goldman's numbers?
What's fascinating here is how heavily the underwriter's valuation relies on a completely technically unproven concept. Independent analysts see a massive, dangerous detachment from fundamental reality. If we look at independent intrinsic value modeling from Morningstar, they calculate a fair value of just $62.51 per share.
Wait, $62.51, that is a 53% discount to the IPO offering price.
Yes.
How do you get $62 when Goldman Sachs is confidently telling the world it's worth $135?
Well, Morningstar strips away the hype, and they use probability-weighted scenarios specifically for those unproven orbital AI data centers. They break it down into 3 distinct paths. First, they have the moonshot scenario.
Okay, what does that look like?
And they assign this only a 7% probability. This assumes everything goes flawlessly. A 59,000 satellite cluster successfully captures 20% of global AI computing capacity. Under this absolute dream scenario, the AI segment adds $154 per share in value.
Okay, so a 7% chance of hitting an absolute grand slam. What does Morningstar consider the more realistic middle ground?
That would be the minimum viable product scenario, which carries a 50% probability. This assumes the orbital data centers physically work, but they face severe capacity and bandwidth constraints.
So they don't take over the world.
Right. They capture just 4% of the global market. That adds a mere $23.50 per share to the company's overall value.
And what happens the remaining 43% of the time in their model?
That is the no-go scenario. Weighted at 43%, this assumes the orbital data centers fail completely. The physical realities of extreme latency, power limitations, and thermodynamics. I mean, literally the inability to air condition a massive server farm in the vacuum of space make it impossible.
That sounds like a pretty big hurdle.
It is. In this scenario, the venture is abandoned by 2028, resulting in write-downs that actually subtract $6.20 per share from the company's value.
Let me make sure I'm hearing this clearly. Nearly half the time in Morningstar's model, this AI space experiment fails entirely and actually destroys value. Yet the Wall Street underwriters are pricing the stock as if the 7% moonshot is practically guaranteed.
That's exactly right.
If the stock is objectively overvalued by independent metrics, how can Goldman confidently sell it at $135? I mean, who is buying it?
This brings us to the most crucial and perhaps most alarming part of this deep dive. They aren't relying on you voluntarily deciding it's a good deal based on the fundamentals.
They aren't.
No. The mechanics of the stock market have been intentionally designed to force people to buy it. It relies on what analysts call the index inclusion loop.
Okay, let's unpack this loop because this affects almost everyone listening to this right now, even if you never plan to log into a brokerage account and buy a single share of SpaceX directly. How does this system force people to buy?
It all starts with the float, the percentage of the company's total equity that is actually made available for the public to trade. In this IPO, only 4.3% to 5.0% of the total equity is being floated.
That is tiny.
It's an incredibly thin supply of shares, and at the exact same time, major global index providers have fast-tracked their rule changes to just jam SpaceX into their benchmarks almost immediately.
Yeah, the sources show NASDAQ reduced its standard waiting period from 90 days down to just 15 days, and they completely eliminated their rule requiring a 10% minimum free float.
Right.
FTSE Russell shortened its window to just 5 trading days post-IPO. And S&P Dow Jones is proposing a 12-month waiver on its usual seasoning and profitability tests. I mean, why are these massive established index providers suddenly bending their own rules? Are they just competing with each other for the prestige of hosting the biggest IPO in history?
It's prestige, market share, and honestly, the massive licensing fees that come with it. They all want the crown jewel of the decade in their index. But the consequence of those rule changes falls entirely on passive index tracking funds, like the ones sitting in your 401k or IRA.
All right.
Those funds are legally mandated to replicate those benchmarks perfectly. If SpaceX is added to the S&P 500, those passive funds must buy SPCX shares to match the index weight. They have to buy regardless of the $135 price tag, regardless of the 93x valuation multiple, and regardless of the underlying financial performance.
It's like trying to force a massive stadium full of people through a single revolving door. The 5% float is the tiny door, and the multi-trillion-dollar passive funds are the crowd being forced to sprint through it.
That is a highly accurate way to visualize the bottleneck. Bloomberg Intelligence estimates that passive S&P 500 funds alone will need to absorb about 19% of that tiny public float.
Just the S&P 500 funds.
Just them. Add in the NASDAQ and Russell trackers, and passive index funds will command roughly 24% of the entire float. And when you include active mutual fund managers who are benchmarked to these indices because they simply cannot risk the career suicide of being underweight on a massive tech stock, you are looking at nearly 48% of the public float being swallowed up by price-insensitive forced buying.
Wait, here's where it gets really interesting. Are you telling me that a passive index fund is legally blind to how objectively overvalued this is? They just have to buy it at whatever price Wall Street sets.
Yes. They are rule takers, not price makers. When you have massive forced blind demand chasing a 5% supply of shares, it creates an artificial buying squeeze. The price will almost certainly surge on day one, not because the company proved its orbital AI works, but simply because financial computers are programmed to buy the stock.
And what happens when the insider lockup periods expire? Usually, like 6 months after an IPO, insiders and early venture capitalists are finally allowed to sell their shares. Does that flood of new shares relieve the pressure on the revolving door?
Paradoxically, it actually triggers another wave of forced buying. As insiders sell, the public float expands. And every time the float expands, the index providers adjust the company's weighting upward in the benchmark.
Oh, you're kidding.
Nope. This forces those passive funds to buy even more shares to maintain their tracking alignment. It creates a recurring artificial bid that continuously props up the share price precisely while the insiders are cashing out.
So essentially, your retirement ETS is being forced to absorb an overvalued, high-risk vehicle to provide exit liquidity for the billionaires who funded it early on.
Exactly.
Which makes sense why the American Federation of Teachers, which represents millions of workers, actually sent a formal letter to SEC Chair Paul Atkins warning about exactly this dynamic. They pointed out that this structure forces everyday retirement accounts to absorb the highest risks before any operational metrics are even independently verified.
It is a profound shift in risk distribution. You have retail investors and passive funds forced into the stock at peak valuations, which leads to the next logical question. If your retirement money is forced to fund this, what kind of voice do you get in how the company is actually run?
Right. Do you get a say in how they spend that $12.7 billion on data centers?
The short answer is absolutely not. This IPO features an extremely aggressive dual-class share structure. Elon Musk holds Class B shares, which carry 10 votes per share. The Class A shares sold to the public carry just 1 vote. Musk owns 42% of the equity, but he retains 85% of the total voting power. He is the ultimate dictator of the company.
And because of that wildly concentrated voting power, SpaceX qualifies under NASDAQ guidelines as a controlled company. This is a crucial loophole. It legally exempts the firm from standard corporate governance mandates. They do not need a majority independent board of directors. They do not need an independent compensation committee to review executive pay.
If we connect this to the bigger picture, this lack of governance combined with extreme valuation hype is a recipe we've definitely seen before.
Oh, absolutely. And it completely explains how that February 2026 acquisition of X and XAI happened. It was a multi-billion-dollar merger conducted entirely between companies that Musk already controls. It was a completely non-arm's length transaction.
Zero oversight.
Public investors had absolutely zero voice in the valuation, zero say in the liabilities assumed, and zero ability to stop capital from being funneled into that cash-burning AI division. Furthermore, the S-1 reveals Musk has no non-compete clauses.
That's a huge red flag.
He could theoretically start another space company tomorrow. And shockingly, despite the entire $2 trillion valuation resting squarely on his shoulders, SpaceX carries no key person life insurance on him.
Yeah, when you combine zero corporate governance, extreme valuation hype, and a supply-constrained float, you get a highly volatile recipe, and it's one the market has tested before, as you mentioned.
Let's pull up the historical data on previous mega IPOs that relied on intense retail demand and constrained supply. Look at Facebook back in 2012.
Right, a classic example.
It was overwhelmingly anticipated. Wall Street bumped the offering price up to $38. But because of internal trading glitches and sudden fears over their completely unproven mobile ad revenue, the stock broke its issue price on day one. It lost nearly 50% of its value in a single month before eventually stabilizing years later.
Or consider a more recent example. Rivian Automotive in 2021, they priced at $78, and the stock quickly surged to $119 based purely on retail hype and a tight float. It achieved a valuation of over $100 billion while having zero meaningful revenue. But when production bottlenecks hit reality and those insider lockups expired, flooding the market with shares, the stock lost 82% of its value in its first year.
And Robinhood in 2021, they lost 74% in their first 12 months. The hard statistic here from the research is sobering. Over 50% of the 30 largest IPOs in the last 15 years traded below their offering price after the very first week.
Wow, over half.
Yeah, and 57% were completely underwater 12 months later. History tells us high-profile debuts routinely underperform once the initial hype fades.
Which brings us to the most practical part of our analysis today. Armed with the knowledge of this structural trap, the Trojan horse bundling of 3 distinct risks, the massive Morningstar valuation disconnect, the index inclusion loop, and the total lack of shareholder voting power, how should retail participants navigate this event?
Yeah, so if you are sitting at home looking at your brokerage app or your 401k, what are you supposed to do with this information? How do you protect your capital?
Strategy number 1 addresses the forced index exposure. Because your standard market cap weighted ETFs are legally forced to buy SpaceX, you will automatically accumulate exposure to this risk. If you want to counter that, capital allocators suggest shifting a portion of your passive holdings away from those broad market funds.
Okay, shift to what exactly?
You might look toward large cap value funds or equal weighted indices where every company gets the same percentage of your dollar, rather than the biggest companies dominating the fund. You could also utilize active managers who have intentionally elected to underweight SpaceX due to these valuation concerns.
But what if someone genuinely believes in the long-term mission of Starlink and actually wants to buy the individual stock? What is the smartest entry point?
The primary rule of engagement here is the lockup expiration timing strategy. Avoid buying on day one.
Just sit it out.
Yes. Do not get caught at the peak of the forced index buying squeeze when the price is artificially inflated. Wait for the sequential lockup expirations. These roll out incrementally up to the 180-day mark post-IPO. This is the window when early venture capital firms like Founders Fund and Thrive Capital are legally permitted to liquidate their private shares.
Because historically, when that flood of new supply hits the open market, the stock price drops. If Starlink is still operationally sound 6 months from now, that post-lockup drop might offer a much safer, more rational entry point, hopefully closer to Morningstar's $62 intrinsic value rather than Goldman's $135 hype.
Precisely. And if you are determined to trade SPCX directly, you really must implement strict rule-based trading. Do not lump sum invest.
Right.
Use phased capital allocation, commonly known as dollar cost averaging. This means buying a little bit of the stock every month over a 12-month period to smooth out the extreme price volatility. Establish hard stop-loss rules so your broker automatically sells the price plunges. You can also use options overlays to hedge your risk.
Let's demystify those options for a second. The sources mention protective puts and costless callers. A protective put is essentially like buying car insurance on your stock. You pay a small premium up front, and if the stock crashes, you have a guaranteed floor price where you can sell it.
Exactly.
A costless collar takes that a step further. You fund that downside insurance by selling the rights to some of your upside gains. It costs you zero cash out of pocket, but it legally caps both your massive losses and your massive gains.
Those are critical tools for navigating asymmetrical risk.
So what does this all mean? We have to ask the ultimate question based on the mission we set at the top of the show. Is this officially a rug pull?
Based on the structural evidence, it is not a traditional fraud. There's no misleading financial reporting happening here. Starlink is a genuinely successful, revolutionary connectivity franchise.
Right, the numbers there are real.
But the structure of the offering is undeniably designed as an asymmetric risk setup. It heavily favors early insiders who get to lock in a massive $135 premium while quietly offloading the severe, completely unproven risks of orbital AI data centers onto public retail capital.
It's the perfect house with the experimental theater and the highly dangerous data center physically chained to the deed.
Yes, you cannot buy the innovation without buying the potential explosion.
To quickly recap what we've uncovered today, we are looking at a massive valuation gap driven by Goldman Sachs projecting a 100 times increase in an AI segment that is currently burning billions of dollars. We have a bundled corporate structure that forces you to swallow those losses just to get a piece of Starlink.
Right.
We have Elon Musk retaining 85% voting power, completely stripping public investors of standard governance protections.
Yeah.
And we have an artificial market squeeze where fast-tracked index rules will force passive retirement funds to buy up a tiny 5% float, artificially driving up the price.
So it's a perfect storm.
It really is. The most prudent approach. Observe the chaos from the sidelines on day one. Wait for those venture capital lockup expirations. Wait for the early earnings reports to show us the reality of those AI margins.
And as we close, there is one final, broader market implication I want you to consider.
What's that?
If nearly half of the public float of a $2 trillion company is eventually held by passive index trackers, what happens to the broader economy if Morningstar's no-go scenario actually comes true?
Right. What if they spend tens of billions getting these servers into orbit and they simply melt? What if the extreme thermodynamics in space cause a catastrophic technical failure of the entire AI network?
A failure of that magnitude wouldn't just crash the SPCX stock price. Because of how heavily weighted this single stock will become in the S&P 500 and the NASDAQ, a technical failure in orbit would cause immediate market contagion. It could systematically drag down the retirement accounts of millions of everyday people. People who thought they were just buying a safe, diversified index fund and didn't even realize they were betting their life savings on the physical viability of space-based AI data centers.
It is a profound shift in how risk is distributed in modern financial markets. When the foundation of this particular house cracks, the whole neighborhood is going to feel it.
Thank you for joining us on this deep dive into the SpaceX IPO. Stay relentlessly curious, stay disciplined in the face of the Wall Street hype, and we will see you next time.